Welcome back to the XRP Insider Network, your go-to channel for the biggest, boldest, and deepest breakthroughs in the world of XRP banking evolution and systemic financial disruption. If you're serious about understanding where XRP fits into the future of global finance and what's coming next, you're in the right place. Smash that like button and subscribe if you haven't already, and turn on your notifications because today's video is one you absolutely don't want to miss. Here's the fire hook. The XRP banking shift is locked in. Forget speculation, forget noise. Across boardrooms in New York, London, Singapore, and Dubai, institutions are no longer asking if XRP settles value. They're planning when and how fast. The financial world is quietly realigning. And if you think this is just about crypto markets going up, think bigger, much bigger. Today, we're breaking this down the way insiders see it, from strategic adoption drivers to the unintended global consequences that not even a lot of industry analysts are talking about yet. By the end of this, you'll understand not just what comes next, but why it's inevitable and how this ties into banking liquidity, cross-border clearing, and the future of sovereign currency flows. Here's the thing about institutional shifts. They don't happen overnight, and they don't happen loudly. They happen in memos, pilot programs, regulatory frameworks, and quiet integrations that set off ripples long before markets react. And that's exactly where XRP is right now, in the quiet phase before the storm. Look, we need to start with the big picture context before we zoom in on what's next. 1. The global liquidity imperative. Banks today are under enormous pressure to find liquidity solutions that are fast, cheap, transparent, and compliant. Old correspondent banking systems struggle under regulatory scrutiny, AML, KYC demands, and inefficiencies that rack up billions in operational cost every year. For decades, the industry has searched for a vetted bridge asset, a way to move value without locking up capital in bilateral nostro-vostro accounts. All signs now point toward a shift to digital settlement rails, with XRP structured to uniquely fit that need. Here's why. Institutions don't adopt a solution because it's trendy. They adopt it because it answers a quantifiable pain point, and banks have huge pain points in cross-border flows. 2. XRP's design advantage. XRP Ledger's architecture, low cost, high throughput, deterministic settlement, checks boxes that correspondent banking dreams about. It's not just about speed, it's about predictability, cost efficiency, and auditability. The three pillars institutional risk officers care about most. That's not hype. You don't get into institutional integration meetings saying, hey, we're fast. You get in saying, here's how much cost you'll save, how you'll reduce settlement risk, and how it fits into your compliance framework. That's the language of banking adoption. 3. The shift isn't hypothetical, it's practical. Across the world, financial infrastructures are being reevaluated. Central banks are piloting digital settlement experiments. Commercial banks are under pressure to provide real-time payments. Regulatory frameworks are evolving to treat digital assets as settlement utilities rather than speculative tokens. That's a seismic shift in how institutions perceive value transfer technologies. Now, if you're new to the space and wondering why this matters, let's break this down. When a bank sends money cross-border today, it often has to lock up capital in multiple banks around the world, pay substantial fees to correspondents, wait hours, sometimes days, for settlement, absorb exchange risk while money is in transit. This is not efficient, it's not transparent, and it's expensive, which means banks are actively looking for alternatives, not because crypto markets are exciting, but because their existing systems are a liability. Here's where XRP comes in. While many digital assets are focused on store of value, XRP's design is built around movement of value. No mining, super low fees, deterministic settlement. These aren't buzzwords. They are exactly what a treasury desk looks for when evaluating settlement assets. Now let's move into the crucial indicators that tell us the shift is locked in, not speculative. Indicator number 1, regulatory clarification. In multiple jurisdictions, regulators have started to frame digital assets in a way that treats them as tools for settlement rather than securities. This is a massive conceptual shift. When regulators align with institutions on how digital assets can be used in day to day value transfer, banks take notice. And when regulators signal clarity, banks move from experimental to implementation testing. Indicator NER2 pilot programs. We're seeing financial institutions publicly announce pilot programs exploring digital asset settlement layers. While XRP isn't always explicitly named in every announcement, when you look at the underlying criteria, low volatility settlement asset, high throughput, regulatory compliance, you see exactly what XRP was designed for. Indicator number 3, liquidity partnerships. There are more liquidity providers, market makers, and OTC desks engaging with XRP pairs than ever before. This is a leading indicator of institutional demand because banks don't engage with an asset unless there's depth, compliance, and predictable execution. So here's the bottom line for Block 1. The groundwork has been laid, the conversations have shifted, the incentives are aligned. Banks aren't asking, is XRP legit? They're asking, how fast can we integrate this into our settlement framework? And that, my friends, is a huge step beyond speculation. In Block 2, we're going to break down exactly what comes next. From phased rollout strategies to regulatory triggers to real world timelines that could define 2026 and beyond, and how every participant from retail holders to institutional partners will feel the impact. Stay tuned, because next we're going deeper than you've ever seen on this topic. All right, let's dive into the next phase. What happens next now that the XRP banking shift is locked in? Not as a hope, but as a practical, unfolding global trend. We'll tackle this section in clear stages so you can see the sequence and timing, not just the theory. Phase 1, Institutional Framework Integration, now through early 2026. In this stage, banks and financial institutions move from pilot programs to structured frameworks. This means compliance layer development, tools that wrap XRP settlement activity with transparent audit trails so regulators and internal compliance teams can validate every transaction. Custody integration, secure institutional custody solutions tailored for banks with governance, reporting, and integration into existing risk controls. Liquidity on-demand systems. Banks that used to pre-fund accounts globally will now test just-in-time liquidity using XRP as the bridge. This isn't a rumor. It's a logical progression grounded in the very problems banks are trying to solve. And here's the secret. Banks don't adopt new rails because of price. They adopt them because of operational necessity. So the question isn't, will banks adopt XRP? It's how fast can banks complete their internal risk assessments and compliance audits? For many global banks, that timeline points squarely into 2026. Phase 2, Regulatory Alignments and Policy Approvals 2026. This stage is a critical accelerator. Regulatory validation signals to banks that digital settlement isn't just permissible, it's best practice. What does regulatory alignment look like? It means clear classification of digital settlement assets in major markets, audit standards for digital asset settlement protocols, reporting frameworks that allow institutions to reconcile XRP transfers with existing financial reporting standards, cross-border regulatory cooperation that treats digital settlement as part of official payment infrastructure. When regulators codify these frameworks, which multiple jurisdictions are already pursuing, institutions cannot ignore the efficiencies. Regulatory certainty also unlocks traditional financing products tied to settlement flows, opening another layer of institutional demand that goes well beyond trading. Treasury Phase 3, Network Effects and Liquidity Scaling, late 2026 through 2027. Once the infrastructure and regulatory frameworks are validated, the next domino falls. Scale. Institutions move beyond testing and begin actual settlement volume. This triggers network effects. More liquidity providers enter the ecosystem because more volume means more profit potential. Transaction depth increases reducing friction further. Price discovery becomes more stable because real economic use cases outweigh speculative trading. Banks begin choosing XRP pathways by default because legacy rails stay expensive and slow. In this stage, the narrative shifts from pilot phase to operational adoption. That's when the industry really starts paying attention. Phase 4, mainstream financial recognition, 2027 and beyond. Once enough institutions are live with XRP settlement flows, the narrative externally changes. This is when major financial media begin pegging XRP not as crypto, but as a core settlement asset. Central banks consider XRP mechanisms in official settlement discussions. Legacy markets adjust valuations based on usage and adoption metrics rather than speculative indicators. This phase doesn't happen quickly, but it does happen when usage becomes visible and undeniable. Now let's talk about the real-world implications of these phases, not just for banks, but for holders, institutions, and financial markets as a whole. Implication number 1, ripple effects on liquidity management. For decades, global liquidity management has been expensive, slow, and opaque. With XRP serving as a bridge asset, banks can reduce capital tied up in foreign accounts. Settlement times fall from hours, days to seconds. Operational costs drop dramatically. Financial institutions can offer faster, cheaper services to clients. This is a practical win, not an abstract one. Implication 2, market reclassification. As XRP's utility grows in settlement infrastructure, markets start compartmentalizing it differently. It stops being just another crypto token and becomes a financial infrastructure asset class, similar in category to SWIFT, but digital, programmable, and far more efficient. This change in market perception alone can have massive effects on institutional interest and retail behavior. Implication number 3, strategic shifts in banking services. Banks that move early stand to capture new cross-border business, offer premium settlement services, compete with fintechs more effectively, build new revenue streams around liquidity on demand. Banks that lag, they risk becoming price takers in an industry that rewards efficiency and speed. Implication, Inertia 4, global accessibility. In emerging markets, expensive and slow banking infrastructure has long been a barrier to economic inclusion. XRP settlement layers can lower barriers by enabling affordable cross-border transfers, faster reconciliation for microtransactions, increased integration into international commerce. Essentially, this is not just a banking shift, it's an accessibility shift. Now, let's be transparent. None of these stages are guaranteed overnight miracles, but the trajectory, based on institutional incentives, regulatory movement, and operational efficiencies, points to real adoption, real integration, and real usage that will reshape how modern finance moves value. And for you watching this right now, whether you're a longtime believer, a skeptic, or someone just trying to understand what comes next, here's the reality. We're not in the hype phase anymore. We're in the integration phase. That's why the XRP banking shift isn't a speculative headline. It's a strategic evolution. And once you see the sequence of events laid out like this, you'll understand how the industry isn't just talking about change, it's building it. If you found this breakdown helpful, insightful, or even mind expanding, make sure you're subscribed with notifications on so you don't miss our next deep dive on how this impacts markets, wallets, and strategic portfolios in 2026 and beyond. This has been the XRP Insider Network. Thank you for watching, and I'll see you in the next one.